Welcome back to another episode of FPO and G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about retirement planning, specifically with executive compensation. So a few episodes ago, or probably a lot of episodes ago, we talked about recreating a paycheck in retirement. And so this will have a lot of some of the same underlying philosophical things, but with the specific tint of what does it look like when executive compensation enters the mix? Non-qualified stock options, RSUs that vest after you separate from the company, deferred compensation plans, and things of that nature. But Justin, got to stop. Before we get into that, did you notice anything different about the intro I just did?
I feel like you kind of altered the name of the podcast a little bit.
Yes, that's exactly right. We were FPOG and now we're FPONG. Couple reasons that we did that. One, it's just more accurate, right? If you think of industry vernacular, O and G is more, that's oil and gas. It's not OG. So it's more accurate, a more accurate description of our podcast. And I would say it's also second reason, time to come clean and just be honest. Hey, you got to do your research before you start a podcast because FP and OG is actually a strand of marijuana. And so to kind of, make sure we're getting the right search traffic and to more accurately describe our podcast, we're going to be FPO and G going forward. So excited for that little update.
I think it's probably a good rebrand. I did not know that was the case, but when you check how we're doing on Google search traffic, and then you see that, I think it probably makes sense to rebrand it and move away from whatever that strand of marijuana is.
Yep. If any of you are thinking about starting a podcast, good testament to doing the due diligence and making sure that it's a searchable, findable term. So with that, let's talk about executive compensation. So I think like a good place to start before we get into the mechanics and all the trade-offs related to executive comp, it might be just good to talk about what do we mean by retirement planning in general, right? Because the industry, I think, has created this vision of you're going to give me your balance sheet and your income. I'm going to plug it into a spreadsheet and basically tell you, can I or can I not retire? Or how long do you need to work? And how much will you die with, right? Like a projection of cash flows almost, depending on the underlying assumption. So is that what you mean? Is that what we mean when we say retirement planning, or what exactly do we mean by retirement planning?
In its most basic form, retirement income planning is generating income, reliable income that you are going to get every month for hopefully decades and decades ongoing. So generating that consistent, reliable income from a portfolio. Jared, I think we could say, 2.0 of that is doing that, generating the income and executing those withdrawals in the most tax efficient way possible. Maybe version 3.0 is doing those two things and coordinating with other planning areas like your estate plan, different risk management factors, things like that. But again, I think if we boil it down, income planning is generating an income, a reliable monthly income that can last for decades from a portfolio. Anything you would add to that?
No, but I do want to dig into what you said. I think that's a great point, but I'd love to give our listeners an example. What's an example of like 3.0 where you say, hey, okay, I'm recreating the paycheck in retirement. I'm doing it in a tax optimally way. But how might retirement income planning touch estate planning?
Good question. So one example of that is, let's pretend that a family has a unique balance sheet where they have a little bit of pre-tax IRA assets, so retirement assets that they do have to pay income tax on upon withdrawal. And then let's say that they have an equal amount in Roth assets, and then they have a really large non-retirement brokerage position. And so one example of estate planning is thinking through which of my children or charities do I want to inherit each bucket of money. Those are different inheritable assets with different tax consequences on all of them. Another kind of tertiary planning issue, in the example I just gave, I mentioned that the largest asset in this family's balance sheet was a non-retirement account, a brokerage account. And so in that, situation, you certainly want to think through, do you have proper liability coverage embedded in your home and auto insurance? Do you have umbrella insurance? Contrast that with a family who has no brokerage assets and all of their wealth is, let's say just a really large IRA account. Well, in the state of Texas, that is protected from creditors. And so their needs on that front are totally different.
Yeah. Yeah. It's almost like a hierarchy of needs, right? It's not really a good use of time thinking through a tax optimal distribution plan if you don't have enough money to retire. Right. And it's not really worth thinking about like, how does estate planning impact this distribution plan if there's like zero probability that you're going to have anywhere close to a taxable estate or even any assets to be inherited by the next generation. So it's, there's different iterations of it, but it's almost like they build on one another. Retirement planning is really, okay, recreating an income stream, retirement income planning, creating an income stream, tax consciously for you, potential next generation, thinking about how it touches other parts of planning. Where does executive compensation fit into that?
With executive compensation, I think you're taking a standard financial planning scenario, so a standard retirement income scenario, and you're kind of putting a steroid on it. And so when you have executive compensation as you move from actively working to retirement, you're typically going to have a scenario where you might have 4 years, 5 years, 7 years and sometimes, Jared, 10 years in deferred comp, where you have a really substantial amount of income that's going to hit after you're done working. And so it's not as simple as I have $5 million. I want 200,000 a year to live off of. Let's figure out how to manage that portfolio, take those $200,000 distributions and do it efficiently and do it securely for 30 years. Instead of that kind of straightforward scenario, it's more of, hey, I've got a big bucket of assets, but then for the next 6 years, I have this unusual income stream that I need to plan around. And that's going to affect your income situation. That's going to affect some of the tax planning that you do. It should also affect some of the way that the rest of your portfolio is invested. What would you add to that?
No, I mean, I think that's a great point, right? Like it changes your retirement timeline. If you retire at 55, we've called the age before, like post-retirement, pre-Social Security RMDs, kind of this golden planning window, right? Where your income's really low and you can accelerate, like a lot of strategies, accelerate income, realize cap gains potentially at a 0% tax bracket, do Roth conversions, right? There's this golden planning window. And when you have executive compensation that is paid after you separate from a company, that's great, but it's also compressed the planning window, right? That golden window pre Social Security and RMDs. And so you got to be really strategic with that. Justin, the other problem with this executive comp, not necessarily a problem, but risk to be managed, is executive compensation. It's disproportionately equity based, right? So a deferred comp plan will pay compensation after you separate from the company, and that's usually cash compensation. But a lot of the stuff that pays out after separation, and each company is different, right? Some companies don't ever offer RSUs to employees when they separate. Some may, depending on the terms they separate on. But equity comp and non-qualified stock options, those may pay out upon separation. Each employer is different, and each role within each employer can be different. But if you're executive comp and you have compensation paying after you separate from a company, a lot of it's going to be stock or stock-related compensation, which on top of managing the income tax complexity, there's a concentrated stock issue. So it's also like, it's not as simple as, hey, how do I optimize the taxes there? If you get $5 million in restricted stock and non-qualified stock options that pay out over the next 7 years, that's not just a big potential income tax liability. That may be a substantial percentage of your net worth tied to a single company and the stock of a single company. And so managing that is, definitely a higher degree of difficulty.
I think you're right. In a couple, examples that we think through, Chevron, you can absolutely retire from Chevron, especially if you're higher up, with really substantial amounts of non-qualified stock options. And I think it's probably helpful to contrast that with RSUs, which you could also have at Chevron. Or Jared, you think about ExxonMobil having a 7-year vesting schedule on RSUs. And the situation with ExxonMobil is you do need to have I don't know what term we would use. Maybe the right term is amicable or agreed upon retirement date in order to keep those RSUs. And so if you think about options, well, options theoretically could be worthless if something bad happens to the stock. And so if you have options to, let's say it's $100 a share and the stock right now is trading at $130 a share, Well, those are attractive options. But then if that stock loses 40% of its value, those options have now become worthless. Contrast that with RSUs. Even if there is a really substantial downturn, you're still getting something. There's still some serious value that is going to vest every year. And so, certainly, both of those scenarios have huge planning implications and probably make you want to tweak your portfolio in your other assets. But the difference between those two, big difference. And that could also provide some different paths that need to be taken or considered.
Yeah. Yeah. The fact that stock options can expire worthless without the stock going to zero puts them in, I mean, a higher risk part of the portfolio, right? So, like, in terms of like your order of operations, there's different tax consequences with non-qualified stock options and RSUs. But I think when you have substantial executive equity compensation, it's probably a big percentage, managing the concentrated stock risk. And in terms of order of operations, non-qualified stock options, one of the cons is that they can become valueless without the stock going to zero. But generally, also with non-qualified stock options, you have exercise flexibility. Restricted stock units, if you get the amicable separation, you know exactly the amount of RSUs you're going to get every year. And so non-qualified stock options stink in the fact that they're a little riskier in terms of they can go to zero without company going to zero, but you do get exercise flexibility. So, especially early on when, you've just retired from Chevron or Exxon and you have a substantial amount of company stock related income coming your way, you might be okay with taking the big tax hit because you can accelerate the diversification process and know in later years you can get a little more strategic with only exercising just enough non-qualified stock options to meet your desired tax bracket that you don't want to go over for whatever reason.
And Jared, I'd be interested to just get your opinion on this. I don't think there's a textbook answer with options, but let's pretend that you're in that situation and you have millions of dollars at stake with options. And let's pretend that you're working this year, you're going to retire next year, and you're going to have some very low income years, let's say 4 years from now. But today, right now, today, you are making a really substantial income, highest tax bracket, and you're sitting with these really substantial non qualified options. Do you exercise them today and just pay a ton of tax? Or do you roll the dice and wait maybe 4 years for a little bit more attractive tax situation, hoping that the stock holds on?
Yeah, I mean, and I'd be curious to hear your answers because I know we have different risk tolerances, right? I would probably be more aggressive in exercising the non-qualified stock options because I'm like a regret minimization, right? If I overpay in tax a little, it is exponentially less painful than the options going to zero, right? And I realize in terms of probabilities, it's probably a lower probability thing, but it's just not worth the risk, in my opinion. And if I'm in that position, it's not going to make or break my retirement if these options go to zero, but it's going to hurt a lot. I would probably front load my de-risking. So let's say, I don't know, we're just using examples here, but I might say, hey, I'm going to exercise 50% of my options this year. And then the other remaining 50, I'm going to use to make sure I don't go above over the next 5 years to make sure I don't go above the 35% tax bracket. But in the first year, I'm going to be way past it and just kind of come to accept that. So I would probably leave some tax optimization opportunities on the back end, but I would just, hey, go ahead and take the tax hit just to de-risk my portfolio and concentrated stock mix substantially. What about you?
I know I'm really fighting with this. I'm not sure what my answer is. So I'll think out loud and see if I come out with an answer. Here's my thought. Jared, I think if let's say that it's a $2 or $3 million event is what's at stake and my total assets are 7 million, no questions asked. I'm doing it today. I'm paying the higher tax rate, right? Like if we're talking about a very material amount of my net worth is all tied up into this, I don't care about the tax rate. I am taking the known win today. On the other hand, if this is like a $2 to $3 million event and my assets are at 30 million, I am not doing it quickly. And Jared, I think what I would do is I would wait until the end of this year to see if we get clarity on whether tax rates are going to go up in 2026 or whether some legislation will happen to keep our current tax rates for a few years longer. But here's the interesting thing. If I know that tax rates are going to go up, Well, then I'd probably just take it today, even though I want to be really clear on this point. There are so many people listening to this that if you're in that scenario that we described, where you have a really high income today and you're going to retire at some point in the next few years, for you, it probably doesn't matter if taxes in general are going up, because taxes in general can go up. But if you're in the highest bracket today and are going to have very little income 4 years from now, well, your tax rate is actually going down, even though taxes in general are going up. But I think that's my answer. If it's a small portion of my balance sheet, I think I'll wait until November and just see if I have some clarity on the tax front. But I still might go ahead and exercise some. If it's a huge portion, I'm not risking it. I'm exercising now.
Yeah. And also, it's a function of what are your other income sources? Like, what is your deferred comp and RSU income going to be?
Yes.
Because, like, if the decision is, do I recognize, like, do I take the big tax hit and, like, at the 37% bracket this year with the potential of getting to the 24 bracket 2 or 3 years from now? That's more compelling than if I have, you know, if I already have 250 in income from RSUs and deferred comp, and so I'm going to be in the 35% bracket regardless, right? Like if my future tax savings is 2% less than 5%, I'm probably, there's less of a premium to wait. And of course, we don't know where tax rates are going, but if the drop off in taxable income isn't substantial due to other income sources, then it's probably might not be worth the squeeze in terms of waiting.
That's a great point. I think the another factor at play is just the amount of time buffer that your other benefits have. So if you're staring at 8 years of deferred comp, well, we're not even close for you having a low income tax year. And so you probably just go ahead and strike with your options. But if you're maybe going to have a couple of years of RSUs, maybe you have a super high income today, then you're going to retire. Maybe you have a huge NUA event. And then by 24 months from now, if there is a low income year, that's a whole different story, which really ties into how you invest should always be dictated by your time frame. And investing in a single stock is always significantly more risky than an index that carries hundreds or even thousands of stocks. But there's also a very different profile. Investing in a single stock for 6 months is not quite as risky as investing in a single stock for 16 years. And so very different risk profiles there.
So how would you think about like portfolio construction in light of this? Like, how do you manage your other portfolio? So like, let's say your first 5 to 7 years of income are like they're accounted for, right? So I think like your retirement bucket, like even though you functionally retired earlier, you don't need to tap those. There's no pressure to produce income on a lot of your retirement assets, like your pension, your 401k, your investment accounts, to produce income for the next 5, 7 years. So how do you think about structuring a portfolio in light of kind of what you're talking about of, hey, you have income post retirement for the first 7 years, and you potentially have a big concentrated stock risk in your portfolio. So how do you think about structuring those accounts in light of those two things that the executive's likely dealing with?
I think on the one hand, it should play a huge role in your macro allocation. And so when I say macro allocation, I'm really saying your decision between how much of your money should be in aggressive growth vehicles, stocks, versus how much should be in safe, secure, fixed income vehicles. If you have a 10-year deferred comp benefit and you are retiring at 59, you get the luxury of investing as if you are 49 years old, not 59. And that should influence you. You should probably take on a little bit more risk because, again, we've said this on this podcast. If you are trying to build an enduring portfolio that produces income for decades, your greatest risk is not a market crash. Jared, your greatest risk is inflation. And so if you have a 10-year deferred comp schedule, you need to be mindful of that greater risk. And you probably need to invest more in vehicles that have a track record of outperformance.
Yeah, with the caveat of it being in a way from a risk management perspective that you're comfortable with, right?
Yes.
Because the problem recreating a paycheck after retirement, they're like, it's vulnerable. It's tough to go from, even if you have deferred comp, it's tough to go from working to not. Right. So seeing a market down crash, even though you have the time horizon to endure it, those are emotionally vulnerable years when you switch from being employed to not being employed. And deferred comp helps with that, and having some income sources kind of helps with that. But right, like just because you've delayed retirement functionally, or the need for your assets to produce income by 5 years, I don't think that necessarily means that the 6-year-old retiree should go, if you're an 80-20 before you separate, go up to 100-0, right? Just so I think you have the capacity to get more aggressive, but make sure it's in line with your risk tolerance.
That's so well put. And then on the micro front, I do think it should absolutely change the way that your portfolio looks in terms of, do you have strategies in your portfolio that lower your exposure to, one, the individual stock that maybe you've got options or RSUs coming, and then two, what about the overall industry that you're in? And so I think the rest of your portfolio should kind of have less weighting to your company and your industry, which, Jared, I'd be interested in your thoughts there. Is it just using S&P X, a specific industry's fund, or where does custom indexing come into play? And what's the best way to think about and build a solution there?
Yeah, if you think about portfolio construction, right, what's really going to drive like a crazy percentage of the volatility is your equity exposure, right? So like if you have $5 million in RSUs that's going to vest over the next 5 to 7 years, that is 100% equity. And not only is it 100% equity, it's 100% one specific company. So a lot of line item risk, right? So if you decide globally, I'm an 80-20 portfolio, and you have this $5 million that's all a single company stock, your remaining investment assets should probably be lower than an 80-20 to account for that asymmetric kind of volatility asset in your portfolio. But in terms of, hey, how do we actually construct the portfolio? Yeah, there's good ways. I mean, custom indexing is awesome, where instead of buying an index fund, you can use providers to recreate an index. And so that's really fun. So instead of buying like an S&P 500 fund, you can create an S&P 500 fund, and there's technology companies that allow you to do that. And you can exclude certain sectors, or you can exclude certain individual stocks. So that might be nice, especially if your holding is a big percentage of the S&P. So, if you get a bigger benefit if you're an NVIDIA employee, doing an S&P fund, because NVIDIA as a percentage of the S&P is probably higher than Exxon, but they're still substantial, right? So custom indexing is a really kind of compelling way to do that and just kind of consciously manage the portfolio, considering I have this systematic risk. I would also say, hey, the way you just produce income needs to be risk management conscious, I would say. So, maybe front loading the acceleration of stock options, or, another thing with RSUs is people get so excited about, oh no, if I hold them for a year, I get cap gains. It said, no, that's if they increase in price. With restricted stock, when it vests to you, it is taxable as income. So if you immediately liquidate and diversify it, all of the future gains will be subject to cap gains, but it'll be in assets that are more thoughtfully diversified. So a lot of people get excited about, oh hey, I had these RSUs vest, and now they're held at a slight gain, and it's a short-term gain, so it's going to be taxed as income. Let me hold it for a year. Yes, you might pay more if you sell it today, but again, when you're managing concentrated stock risk, it might just be worth paying a little bit more in taxes. So thoughtfully diversifying the stock options, but then as the RSUs vest, liquidate and diversify, or liquidate and use as a source of funds for living expenses, right? You're going to pay the income tax anyway. So you might as well, either use it to diversify or use it as a source of funds for funding the first few years of retirement.
Jared, I could also make a case that if you're in this situation and you have a really substantial deferred comp benefit or really substantial RSUs over the next 7 years, there's a good chance that you're going to need to do substantial family gifting for future estate planning. And so, if you have these benefits, it's not crazy to think that your total asset level could be 20, 30 million or more. Well, let's say it's 25 million and you're married. In that example, you do not have a taxable estate today. So it really doesn't, you're not doing any crazy planning in the next year to remove 27, 28 million from your estate, because that would be removing every dollar from your estate. But what you do need to do is think through, okay, I've got 3 kids, and every year I might be gifting the annual gift exclusion. So you might be giving $36,000 a year to your children, maybe in a certain vehicle that doesn't necessarily give them access today. It could go into irrevocable trust for them and be invested. But the consequence of doing that, Jared, is well, you had this big deferred comp plan. You had this big RSU vesting schedule. Therefore, you weren't actually taking retirement income for 5 more years, 7 more years. But if you're at that asset level that I just mentioned, you kind of are taking income immediately, year one. You're not going to be spending that income, but it is going to go into vehicles for your children for the purpose of lowering future estate taxes. And so, kind of an interesting wrinkle that it could almost kind of balance out where really you are still executing an income distribution plan, just not one that's for you.
Yeah, multidimensional in terms of income, not necessarily your tax rate, but the tax rate of the people inheriting that asset. So, Justin, with like, I guess the other thing that kind of to put a bow on it, I would say, we talked about risk tolerance. Hey, if you have 5 to 7 years of income, your first few years of retirement, you can get more aggressive. But also, like, another reason to kind of maybe skew conservative is like, there's no guarantee that equity comp is going to pay out, right? Probabilistically, it is. But what you don't want to happen is you don't want to say, hey, I have this equity compensation that's covered my first 5 to 7 years retirement. I'm going to go 100% equity. And I think the same environment that causes your equity comp to become worthless or substantially reduced is probably a similar market environment to one where your equity is in substantial drawdowns, right? So in terms of risk management, you don't want to be overly aggressive, just presuming that it's going to be there. Of course, you need to prepare as though it's going to be there, but also having a more defensive pile of money in the event that probabilistically it's not going to go to zero, but it pays out at an underwhelming rate relative to what you thought it would.
That's right. That's such a good point, which is just, I mean, Jared, I think this topic is just so fascinating because at the end of the day, income planning, that part of financial planning is the genesis of our entire industry. And so I would say financial planning as an industry was kind of birthed in the 80s or 90s and really just became a little bit more mainstream in the last 20 years. So investment managers have always been there. There's always been different professional investors. But when you think about financial planning separate from asset management, that is the genesis. It's income planning. It's, hey, I have this bucket of money. How do I turn this bucket of money into a reliable source of income that protects the principal and passes the principal down to heirs and allows me to live off of it for the next 30 years? That really was the beginning of it. And Jared, it's a topic that's relevant if you're at the beginning of your financial journey. If you have 100,000, you are building toward financial independence. But it's also relevant if you have $1 billion and you're thinking through how much of our family assets need to be preserved just for income for children or grandchildren. And it all kind of comes back to duration matching and thinking through every asset in your balance sheet, give every dollar a job, and that job should be governed by the amount of time that those dollars are at stake. And so it's a topic that's kind of at the beginning of financial planning, and it's a topic that's relevant whether you have $1 or a whole lot more.
Yeah. And I mean, these are just principles, right? The application is super personal, right? There's so many variables that impact this, right? Like if you've decided, hey, I'm going to move from Texas, I'm going to become a resident of Colorado, like that's exciting. Good for you. You're also going to pay state income taxes. So that might change the speed at which you accelerate things, right? And so with all of these rules, we could probably point to an exception where we did the opposite of the principle that we just spoken to, that we just gave you, because it's just so personal and a function of A, what are you solving for? B, what does your situation look like now and in the future? And C, what is your risk tolerance and risk capacity? And these are all personal decisions. But if you have questions about, hey, my specific employer has these 4 things, talk about them in specifics. We're happy to get more in the weeds, but wanted to do a general overview with all of our different listeners at all of our different companies with all of their different executive compensation. We hope this is helpful and we love hearing from you. Shoot us an email or ideas for future episodes, podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.